tuning in. Today's video is going to be about a few things that I found interesting and I'd like to talk about. All right, first of all, interest rates. So let me pull up this page I have here. And this is basically a 40-year chart of the history of interest rates, and specifically we are referring to the 10-year treasury yield here. So this is from 1980 to 2023, so a little more than 40 years, 43. And this should be somewhere around 1982, where the high water mark for the 10-year treasury yield was 15.8%. And notice that for the most part, rates have gone down over the last 40 years. If you were a charting expert, you could draw one of those trend lines that would confirm that with a recent breach somewhere around here. So for 40 years, 40 plus years, we've had declining interest rates for the most part. Recently, rates have started to rise. That was after 2020. So we've had a 40-year down cycle and a 3-year up cycle. Now, something else that's kind of interesting is that if we look up, let's go to average age of an American, 2019, 38.1 years. So for the average person, age-wise, who's been in this country, alive in this country, rates have been going down their entire lifetime. So we can simplify rates from their perspective and say, all they know is that interest rates go down. This is a recent phenomenon, rates going up. So again, basically their entire lives, rates have gone down. Anything that happened before they were born, they might not know about as far as interest rates. I do know people who sold homes right around this period, and they were able to bank their money at 20% long-term CDs, which means that according to the rule of 72, their money doubles every 3.3 years. Some people I know who did this, they basically used that money to pay for their parents' retirement. Hey, mom, hey, dad, you don't got to worry about it. I got you covered, blah, blah, blah. But anyway, rates are on a long-term downtrend. Now, let's take a look at a quick mortgage calculator. And this looks good. Let's use a $500,000 home price, 20% down payment. So the down payment is $100,000. The loan term is 30 years. And we're using a mortgage rate of basically 8%. So as we can see here, the monthly payment is going to be a little more than $3,300 per month. And if we multiply that by the 360 payments, let's do 3,300 times 360 payments. So that's basically 12 payments every year for 30 years. We see that this house, for them to break even, has to basically be worth $1.2 million. This is the home that they bought for $500,000 after all is said and done, and this is just paying their mortgage down after 30 years. The house has to go up to $1.2 million for them to break even on this. And another way to look at this is that, all right, in the current housing market, with the various factors and variables that have made prices go up over the last few years, what's actually the product here? Is it the house? I would argue that the product is this mortgage. The product is not the house, because the bank or whoever you got your mortgage from, they're not going to hold your mortgage. They're going to repackage it and sell it, which was part of what was going on during the housing bubble, 2000 to 2008, let's call it. And once again, the product is the mortgage, not the house. So think about that. Now let's go quickly back. Let's look at another chart, since I mentioned a bubble. And this is a chart of a graph of the historical median home value. And let's look at this time period, which is basically from 2000. Well, this starts at 1994. Prices were slowly rising in the 90s, and then they started to pick up steam in 1998. And the period between, let's just call it '02, you can start at 2000. It's not going to make much of a difference. But 2000, 2002, up until roughly this period here, 2006, this was known as a bubble. And you're not really sure that you're in a bubble when you're in a bubble, but when you're out of the bubble, you know it was a bubble because, as we all know, we're all keenly aware of what happened to housing prices after this period. They crashed. Okay, and we can see here that it went down to, and this is the median home price, 173,000, and the high water mark was roughly 216. This is national. There are obviously pockets in the country where the prices were wildly higher than this, and the falls were from the high much, much worse than the median. Anyway, after the low water mark here, let's call it 2011, 2012, prices started to rise. And during this recent period, interest rates started to rise. So what I want to get at here is that with this housing price rise, I hear a lot of people refer to it as a recovery. Now, is this a recovery? Because if this period from 2000 to 2006 was a bubble, and now home prices are back to not only the high of the bubble, but higher, is this a recovery? Why are people calling this a recovery? If you're recovering in bubble territory, to me that sounds like another bubble, not a recovery. So not necessarily a small point about the terminology that they're using there, but what I'm trying to get at is that it's definitely something to think about. And interest rates are now starting to rise again. Let me go back to this visual. Interest rates are starting to rise. And the only thing that most people in the country know is that interest rates go down. I mean, why would they think otherwise? Because rates have basically gone down their entire life. Are they aware that rates can go up? And who says that this is where it stops? We can all go to the Fed Watch tool and get an idea of what the bond market, which is the backbone of the U.S. economy, is telling us about rates over the next few months or the next year. But who says that rates aren't going to go to 10% or 11% or 12%? Just because they've been going down your whole life, if you're a 40-year-old, it doesn't mean that they're going to go back down. So that's something else to think about. All right, now let's look at this in terms of another product. And we'll go to the SPY here, which is a proxy for the market. And let's go out roughly a year. So let's go to September 30th, 2024. And we can see here that the market's currently pricing in roughly a 64.5 point move from either side of current prices, which are about 430. So let's go to the high end here and see what it would cost us to purchase a call. It's just outside the expected move. So let's go to the 500 strike price, and we're going to queue up buying a call. And this is going to cost us $6.72. So for this product, for you to break even on it, it would have to go to $506.72. And if we look at that from current prices, relative to current prices, let's, this is going to be, move this over. So we're going to say, let's call it 507 divided by 430. Bingo. So this is going to have to go up from current prices about 18%. So 430 times 18%, 1.18. That's going to give you roughly your break-even price of 506. Now, if you were going to buy this call, how would you feel thinking that, all right, for me just to break even on this, and this is going to cost you $672 for the one lot. This is 6.72 times 100, by the way. So it would have to rise 18% for me just to get my money back. Just to get my money back, 18%. All right? Let's jump over to our housing price again. And let's take a look at this mortgage calculator. We're buying a home for $500,000. We make these payments for 30 years, and I believe the number was close to 1.2 million. So let me punch this in again. 318 times 360 payments. All right, so 1.2 million, and divide that by your 500,000, what you're paying for the house, and notice how much this housing price is going to have to rise. So as you can see, for you to break even on this house, you're going to have to go up, the price of your home is going to have to go up almost 240%. 240%. And not only that, for you to get into this deal, you're going to be paying $3,318 a month for it. And not only that, for you to get into this deal, you have to come up with $100,000 to put down the 20% that would be considered reasonable for someone buying a home. 240%. The market is currently pricing in break even from here a year out in time, 18%. And you got to make 240% on your home. How does that sound to you? All right, let me go to the other side of this expected move. And let's say that we're on the low end and you want to sell a put at a strike price of 360, which is just outside the expected move. All right, we're going to get $878 for this, and it's going to use $3,600 in buying power. So let's punch in the numbers again. This looks like it's going to be roughly around 25%, but let's check. 878 divided by 3,600. All right, 24.3%. So if you sell this put for 878 and the market stays above 360 at expiration, which is 348 days from now, you're going to make 24% on your money, because this is what it's going to take for you to put on this contract in buying power, $3,600. So you make a 25% return here. Now imagine if you were doing these, put out a few of these every 2 weeks or every week for a while, and you ladder them however it suits your risk profile or your parameters, your risk parameters, or your risk tolerance. And then you just take them off every so often, whatever time period you decide suits you. So if you can take this off for a 25% profit, that's fine. You have several on, you put on a new one, a fresh one, and you keep however many laddered along the way. But the point is, you're making money here by doing this. Whereas if you bought the other end of it, and let me clear this because that's the way you like to roll. You'll buy the 500 strike price. It's going to cost you $672. Your max loss is going to be $672. That's what it holds in buying power. But you need an 18%. You need an 18% lift boost from here. Or you say, hey, if I had to, if the market went down by this amount and I ended up owning the SPY at 360, how would I feel? Would I feel terrible about it? I would say probably not. You got this product at 360. It's currently trading at 430. All right. Anyway, that's going to wrap it up. Just a few things to think about. Remember, well, I've heard some weird talk about the housing market and interest rates and what people can afford and what they can't afford and how they view things. So again, imagine if you bought this call, okay, and you put down $100,000 to get you into this call, and now you need a 240% increase over the life of this contract for you to break even. To me, that sounds absolutely bonkers. All right, thanks for tuning in. I'll catch you guys later.